IIP indeed is the big story. So what are the expectations? Let's discuss that, and let's dissect expectations with our two experts, Shubhda Rao, Chief Economist with Yes Bank, and Siddharth Sanyal, Chief India Economist with Barclays Bank. Siddharth, good morning. Thank you for joining us. Shubhda, you go first. At Yes Bank, what is your IIP estimate for the month of April?
We are a tad lower than the consensus. We are at a 0.9. Quite clearly, the drags that we are seeing is continuing on the manufacturing side, as well as a very, very muted number on mining. Electricity has surprisingly held up decently well at about close to 5%, 4.8 to be precise is our estimate. So I think overall the usual suspects will continue to drag. On the use-based side, I think, it's intermediates which continue to remain in the softer patch. Capital goods is the big joker in the pack. We have seen wild swings, month after month. So that is something very hard to predict. But I think all eyes would be on consumer durables because at least the GDP data seems to suggest now that the consumption is also, coming off. Although I must add that it is more evidence on the government consumption side than the private consumption side. But overall consumption is likely to remain in a softer patch. Having said so, I think April numbers are typically, at least in terms of index, they ramp up as compared to a ramp up in March, they unwind in April. So at least index would start showing something of a lower print. And yes, there is a decent positive base, particularly coming in capital goods space. But overall, I think what we really need to concentrate is the seasonally adjusted, sequential month-over-month momentum, and that seems to suggest the softening and the declining momentum continuing. The PMI has come in a bit positive, no doubt about it. It has held steady at 54 for some time now, which really doesn't, tell you a story that, there's a big uptick happening in industrial production or anything like that. But overall, it may be in the positive range. And I don't know whether we need to take solace in that, finally it's in positive range after March. But the fact is that the softness continues in the manufacturing-led overall IIP decline.
So that just want to get you in. After last month's negative 3.5 figure, what are your expectations from the IIP figure, and how do you see mining, manufacturing, electricity, the various segments panning out this time around?
The expectation for the month of April also is pretty subdued. We are pegging the expectation at around 1% year-on-year growth, which is not a great number. As such, the overall IIP is in terms of its weight, is typically dominated by the manufacturing segment. So the manufacturing growth rate would have to come somewhat close by. Now the mining sector is not really doing well. It has its own set of problems. The brighter spot here is actually the electricity part, which is actually growing at a pretty decent pace. We expect the same pattern to actually hold in the month of April also.
Shubhda, on a scale of 1 to 10, after a GDP shocker, to your mind, what are the chances that we could be in for IIP shocker?
Probability seems a bit low because the base effect may come into support, and the proxy indicators do not seem to suggest a collapse. So I would be really surprised if IIP comes in a deep negative zone. So at this point, I think I would still be on the betting side of the positive number rather than on the negative print.
Siddharth, and how are you viewing the lead indicators, the infrastructure index of 8 core industries, because that came in at 2 to 2.25, and the HSBC composite PMI stood above 50?
As such, if you see the PMI hovering in the early 50s, that means it's suggesting some kind of a thin expansion in overall economic activity. So that way, our expectation of 1% odd IIP growth is pretty much in line with that. The core sector has grown somewhere at around 2.2%, and this is close to 40% of the overall IIP basket. So as such, based on all these factors, we are pegging the number at around 1% year-on-year growth. If I see some of the other lead indicators also, there is no sign of any major turnaround, at least in the very near term. If I see the trajectory of credit is somewhat lagging. If I see what is happening in case of intermediate goods, the intermediate goods production is typically a very good lead indicator with a 2 to 4 month kind of lead period. That is also not doing really very well. So all the lead indicators, none of the lead indicators are really suggesting any quick turnaround in overall industrial activity.
Shubhda, we have IIP today, inflation later this week, and then credit policy on Monday. This week's macro data, to your mind, how do you think it will influence Monday's credit policy?
I think to put it in perspective, we need to know from previous policy statement to the forthcoming policy statement, what are the factors which have seen a change. 3 factors to my mind. One, on the global front, the risks have perhaps intensified more as compared to the last time. Second is quite clearly the crude oil prices have trended lower, which I think to an extent is a relief. Of course, the weaker rupee does offset some of the gains, but the fact remains that it's been trending lower. The third, of course, was the GDP growth, for the last quarter of FY12, and of course, any absence of any dramatic uptick, seen in the incremental data points. So I think these 3 factors do seem to suggest that, RBI may be inclined to review and rather look at a rate cut in repo by 25 basis points. At least that's the assumption that we are holding as of now, because we believe that, yes, everyone knows and we all endorse the view that a large part of the onus significantly lies in the government's arena in terms of correcting the fisc and, creating some kind of a positive environment for investments to kickstart, and all those things are well accepted, well endorsed and articulated by everyone else around. But the fact remains that, yes, at some extent, cost of capital will matter, and, we need to see currently the growth rate is well below even the revised trend rate of growth, which is around 7.5. So I think from that perspective, I would probably believe that RBI would look at these factors all in toto and go in for a rate cut of 25 basis points on 18th June.
So what is your sense, with the RBI hinting to rate cuts due to decline in global oil prices as well as the growth slowdown? What is it that you're expecting by terms of a policy action come June 18th?
Well, earlier the RBI had been guiding that the headroom for rate cut in near future is very, very less. But we had been in the camp flagging that the core inflation trajectory is softening, and RBI at the moment is actually emphasizing on core inflation a lot more than headline inflation. So if there is a requirement from in terms of supporting growth, RBI will actually deliver rate cuts even when the headline inflation is high. Now, in the last few weeks, given the softening in global commodity prices, particularly in case of oil, and the big downside surprise in India's fourth quarter GDP number, the possibility of rate cut has actually gone up in case of June policy also. But without getting into the debate of whether there is actually a rate cut in June policy or we have to wait for one more round of policy, the important message here is going ahead over the course of the next few months, possibly RBI will be cutting rates more than what the market is currently pricing in. So that way, we are pretty confident with our call of 50 to 75 basis point of further cut in the repo rate in the coming months.
Shubhda, money market or money managers are of the view that a 25 basis rate cut is baked in. And given the kind of global environment we are in, Europe is still uncertain, Greece is a disaster, commodity prices are above the a basic tolerance level. Anything beyond 25, RBI would be stretching themselves?
I think we have to look at it from combined kind of a view. One is, of course, affecting a rate cut, and the second is how effective is the transmission through the decline in the lending rates from the banking system. For this, you need not just a rate cut, but a kind of a visibility of comfortable liquidity on the horizon. And I think that, in recent weeks at least, we have seen the liquidity coming back to a relative comfort zone. Having said so, I think going forward, particularly over the next quarter or two, we will see seasonal factors, contributing to contraction in liquidity. And as such, I think it's very important to take on board the assumption that RBI may have to do a kind of a signaling in terms of a rate cut, as also facilitating it through transmission through liquidity easing measures, which we believe currently OMO is the preferred route. But as we go into the second half of the year, we could definitely see a CRR cut also coming on board. In fact, we assume that about 100 basis points of CRR cut can be penciled in for the second half, because it's very clear that why the India Inc. would also fret about is if 25 basis points, is it enough? Will it be enough for the banking sector to push for a cut in the lending rates? I think it needs to be then juxtaposed across through the liquidity outlook as well. And to my mind, I think both need to coexist for transmission to be most effective.
So that before we let you go, your outlook on the currency as well as the twin deficit over FY13.
If you see the level of current account deficit, it's persisting at a pretty high level for quite some time at the moment. Now, wherever it hovers, possibly it will be hovering somewhere in the range of around 3.5% in the coming quarters or for the year as a whole. That means our current account deficit will be somewhere around 70 billion US dollar for the year as a whole, which is a pretty high number. Having said that, we think that capital flows, all kinds of capital flows put together, FDI, FII, ECB's short-term borrowing, banking capital, all flows put together should be able to more or less cover this particular current account deficit. As such, thus, we don't really see any major issue in terms of having a big balance of payment deficit or something like that. On the other hand, the fiscal situation is typically currently hostage to the overall growth cycle. Typically, in case of India, fiscal dynamics is very, very pro-cyclical. And whenever growth cycle is weak, fiscal situation takes a big hit. We are going through that, and we have to see what kind of growth, how the growth scenario pans out over the course of the next few quarters. And the fiscal scenario will depend a lot on that.